Coming up on Business Incorporated. MTN and Airtel get payment service bank license. Global food prices hit fresh 10-year high. And Egypt repays $15.8 billion in foreign debt. Welcome to the program. I'm Ladi Williams. Let's kick off with market numbers now. Well, thank God it's Friday. The two giants of Africa were in the green at intraday. Nigeria's index was up 0.10%, while the GSX index in South Africa was up 0.19%. Egypt closed on Friday, but ended Thursday's trading session down by 0.61%. Kenya closed on Thursday down 0.94%. And on to the Middle East now. Markets are closed on Friday. However, on Thursday was the last trading day for the weekend in the Middle East. We saw more positive sentiment. The only laggard was Dubai. The Abu Dhabi was up 0.61%, while Dubai's index slipped by 0.05%. In other parts, Saudi Arabia's Tadawul share was up 0.57%, while Qatar added 0.46%. All right, let's take a look at what's happening in Europe now with Chelsea Delaney. Great to have you, Chelsea. Well, the DAX in Frankfurt climbed again after closing at a record high on Thursday. What's driving these new highs?
Well, the DAX had been one of the laggards here in Europe and across the world, but it has once again reached these new highs. We've also seen stocks in France hitting new highs today as well. A lot of that does have to do with central banks. Central banks are being a lot more dovish than investors had feared. We are in the situation where inflation is rising very quickly, but the economies haven't really recovered from the pandemic fully yet. So it seems from what we've seen this week from the Federal Reserve in the U.S., from the Bank of England, that central banks are moving towards pulling back stimulus policies, but they're not there yet. So for investors, that's pretty good news because a lot had feared that this inflation surge would force them to be more aggressive. It doesn't seem to be the case yet. We've also seen a lot of corporate earnings for the third quarter really coming in stronger than investors had feared. We do also have supply chain issues that are making it difficult for a lot of companies to keep production going. But from what we've seen, for example, from BMW here in Germany or even Nintendo in Japan, even though these companies are struggling to get products, they still are actually posting profits. They're still managing to grow. So that has helped to ease some of those concerns as well.
All right, and Europe is back at the center of the pandemic with new infections hitting record highs in Germany. What are the risks to the economy from this new wave?
Well, there definitely are risks. Here in Germany, we've been reporting about 37,000 cases a day, both yesterday and today. That is a new record high. We also heard from the WHO that Europe is now the epicenter of the new waves of infection. So this is something that is very worrying for businesses who don't want to see another lockdown. What we've heard from officials here in Germany and other parts of Europe is that they really don't want to have to lock down the economy again. So they're very against that. They're really hopeful that they won't have to do that. What they're looking at is potentially making it more difficult for unvaccinated people, introducing new restrictions for the unvaccinated. But that would hopefully allow businesses to stay open. What we've actually seen already, though, is consumers start to grow a little more wary with spending. We saw European retail sales data today that actually fell, and analysts had been actually expecting an increase. So that was a disappointment. And Germany was actually the steepest of those declines, down about 2.5%. So that's really the first area where we could start to see these coronavirus fears impacting people. If people become concerned about, spending again, if they don't want to go to stores, if they don't want to go to restaurants, that's an impact on the economy that we could start to see quite quickly.
All right, we'll keep watching that. But the Chinese real estate market is once again in focus. Another developer, Kaiser Group, faces a liquidity crisis. Are investors worried this will be the next Evergrande?
That's definitely a concern. Kaiser does look to be having a lot of the same issues as Evergrande. Kaiser is much smaller. They're only about the 27th biggest developer in China, but they're also one of the most indebted. So they have about $10 to $11 billion in debt on offshore markets, and some of that debt is coming due. So they've already missed some payments to investors who had bought wealth management products from them. They also have a $400 million bond note due next month. It's unclear if they'll be able to make that payment. They are trying to sell off some assets to raise cash, but it's unclear if they'll be able to really sell enough. Kaiser is not the only company in China, obviously, that's having these issues. What we've seen in the wake of the Evergrande implosion is investors, banks becoming very, very hesitant to lend to developers in China. They're concerned about the existence of these companies. So it's a lot of these real estate developers are facing a cash crunch. The most heavily indebted ones likely will have issues paying back those bonds. And we're also seeing this impact the broader Chinese economy at this point. We've seen over the past couple of months new home sales start to plunge because home buyers don't want to invest money in a company that might not actually exist in a couple of months. So for an economy that's as dependent on real estate as China, that's a major concern. But I'd say at this point, it hasn't started to spill over onto global markets as we had seen with Evergrande in the early days. For now, investors do see this as a risk that's contained within the Chinese real estate sector.
Contained. All right, Chelsea, always great to talk to you. Thanks for the update and enjoy the weekend. Moving on to the UK now, let's bring in Juliana. Great to have you, Juliana. Well, property prices have reached the highest annual growth in the capital's most expensive district since 2015. What's driving this rise?
Good afternoon, Laddie. It seems to be the reopening of international travel. The international jet set group, very small elite group, they're back in town. And this is according to real estate group Knight Frank, who have some data that they released earlier this morning showing that retail prices, well, not retail prices, the prices of property in prime London locations are up 1.1% year on year. Prime London is really stretching between just a few zones, predominantly in Zone 1, so between Chelsea to Camden, Notting Hill, Westminster. During the pandemic, there was a dip in those areas, and that's because a lot of people working from home were sick to the back teeth of the rat race and decided to sell up and get out to the country so they could have more space. But now that it's much easier to travel, we are starting to see the wealthy come back to London, and they are doing what the wealthy like to do, which is invest in property. Another real estate group, Savills, just this year alone, they have sold over 20 properties with a price tag of over £15 million or more. I can't work out the Naira. I'm not sure what the rate is today. Laddie, you can do those calculations, but it's a lot of money. But yeah, good for the property sector, I suppose. A little bit out of reach for people that are trying to get on the property ladder. And this obviously comes from earlier this week, where on Monday, I believe, Nationwide released their house price index, showing for the first time ever that the average cost of a UK home has peaked £250,000. This is, of course, outside of London. Right.
Well, let's look at post-BOE meeting. The sterling is continuing to swoon after the Bank of England left rates unchanged yesterday. How are investors reacting, and how's the market looking this intraday?
Yeah, the market's in great shape. Typically, when we see a fall in pound, we can see a surge in FTSE because the FTSE is predominantly focused on international stock. So a weak pound is great for them. As you were talking with Chelsea and Frankfurt just now, it does appear as if some central bank governors are on a wait-and-see sentiment when it comes to raising interest rates. Lots of analysts had priced in the Bank of England Governor Andrew Bailey making that decision yesterday. Alas, it didn't happen. Now, lots of people are looking to February rather than December for when interest rates will rise in the UK for the first time in 3 years. So the market at intraday, the all share is up 0.71%. The FTSE 100, that's up by 0.65%. And the FTSE 250, the domestic market, that's up by 0.97%. In the currencies market, the British pound is down on the US dollar right now by 0.46%, down on the euro by 0.26%, and down on the Japanese yen at intraday by 0.39%.
All right, it's the end of the week. What are we expecting for next week?
It is the end of the week. It's been a busy week. Lots of COP. COP continues next week, and still we are expecting some Q3 trading updates to continue. I suppose the most important day next week is going to be Thursday, when we are going to start looking at Q3 numbers here in the UK. It's been a bumpy ride in Q2, so through the months of April to July, we saw GDP rise in this country by 5.5%, much higher than analysts had predicted by about 4.5%. But we're not expecting such a big surge during those other months. It seemed a little bit rocky. There were some issues that we had with pandemic, lots of people staying at home, being called to come back because of the coronavirus app. Even though that's all been fixed, it is still going to reflect in those numbers. So we'll be having a look at that. I believe some economists predict that UK GDP will rise in the third quarter by between 1.5 and 1.7%. Also, as well, we're going to get on Tuesday some data from the British Retail Consortium looking at retail sales year on year. Fundamental, because we're going into this all-important Christmas season. This is the time when retailers, particularly here in the UK, are really going to try and get back some of those losses that occurred during the earlier months. But we've got labour shortages, we've got supply shortages. So things are looking tough at the moment. But I suppose we'll just have to wait and see, Laddie, what the data reveals.
Yeah, wait and see. All right, Juliana, thank you so much. Enjoy the weekend.
Thank you.
All right, moving on now. Stock futures were muted in early morning trade ahead of the highly anticipated October jobs report. Futures on the Dow Jones Industrial Average fell 24 points. While the S&P 500 futures and NASDAQ 100 futures both hovered above the flat line. Investors are awaiting the release of October non-farm payroll numbers. Consensus estimated call for 450,000 jobs added, according to Dow Jones. September report tallied 194,000 additional jobs, far short of the 500,000 estimate. Well, let's get yesterday's trading details from our U.S. correspondent, Maria Bird. All right, let's get yesterday's trading in the U.S. from Maria Bird now.
On Thursday, the U.S. stock market had another great closing day, as the Nasdaq set a record, and so did the S&P 500. The Nasdaq closed at 0.8% up, the S&P 500 closed at 0.4%, and the Dow Jones closed at 0.1% up. The Federal Reserve Chair, Jerome Powell, was seen visiting the White House on Thursday. In February, his term expires, and so this was a meeting to see what could be next for the Federal Reserve. It is unclear whether or not President Biden will extend his term or will tap someone else for the position. Chairman Powell also stated earlier this week that he does not expect to see huge interest rate spikes, but he will be decreasing the amount of stimulus money going into the economy. This does play a role in potentially some of the high rates for groceries and gas. Many people are a bit concerned, but are glad to see that interest rates could continue to stay stable in the coming months.
All right, that was Maria Bird there, U.S. correspondent. Well, stocks in Asia Pacific were mixed. There's shares in Hong Kong led losses among the region's major markets. Hong Kong's Hang Seng Index slipped 1.41% to finish trading there at 24,870 points. Mainland Chinese stocks closed lower, with the Shanghai Composite down 1% to 3,491 points, while the Shenzhen Component shed 0.63% to 14,462 points. Elsewhere, Asia-Pacific stocks were mixed as South Korea's Kospi fell 0.47% to close at 2,669 points. Shares in Japan also declined on the day as the Nikkei 225 slipped 0.61% 0.6% to 29,611. And the Topics Index shed 0.69 to 2,041 points. The S&P ASX 200 in Australia gained 0.39% to close at 7,456. On Taiwan's TAIEX jumped 1.28% to finish the trading day at 17,296 points. MSCI's broadest index of Asia-Pacific shares outside Japan declined 0.23%. And now to the global oil markets, OPEC and its oil-producing allies have agreed to continue with their current output plan, deciding against loosening the taps in the face of a multi-year high in crude prices and the U.S. pressure to help cool the market. The group known as OPEC will roll over its August program to gradually increase oil production by 400,000 barrels. Well, we're going to break now. After the break, we look at stories on the African continent. That's in a moment. Do stay with us. And welcome back now to our next conversation. The world is warming up due to emissions from fossil fuels used by humans like coal, oil and gas. Extreme weather events linked to climate change, including heat waves, floods and forest fires, are intensifying. It was Energy Day at the COP26 climate conference in Glasgow yesterday, and some pretty big announcements were made on the end of coal and fossil fuel financing. A couple of African leaders have made pledges at COP26. How would all of this impact Africa? Let's talk to Ted George now, Chief Narrative Officer at Clio's Advisory Services. Great to have you, Ted. Thank you for joining us.
It's great to be back, thanks.
All right, so how severely at risk is Africa from the impacts of climate change?
Well, I think the thing is it's divided into two things, really, physical risk and transition risk. So the physical risk, if you think of the change in the weather, most of the African population is dependent on agriculture. Most of agriculture is rain-fed. And we're already seeing the first signs of climate-induced famine, for example, in Madagascar. And then you have fires and flooding displacing people and collapsing fish stocks when you think of all the coastal communities that depend on that. And then there's the transition risk. So how do you actually change from what you're doing now to being more sustainable? So if you think of Nigeria, heavily dependent on oil extraction and exports, or you think of the Congo on minerals, that's a real challenge. But there is an upside, because actually most African countries are net zero, or in fact, they're actually net positive in terms of their carbon sinks. So there's an opportunity, is there, for investment to actually protect that.
All right, then, what is, there have been a lot of pledges. Now, what is the COP26 pledge to end deforestation by 2030 mean for Africa, and which countries and regions will be most affected?
Well, I think something had to happen because it's extremely serious, the amount of deforestation. It has really accelerated since COVID. An area the size of Switzerland was destroyed in the last year. And one of the main areas for this is the Congo Basin, which is the second largest forest area in the world. So we saw the president of Gabon saying that he wants to see sustainable practices for logging and for more preservation as well. But I think the key here really is about involving local communities, because they are the ones who need to continue to prosper. They need to be the right incentives, so they are helping to protect the forest rather than contributing to its destruction.
And transitioning Africa to a fully sustainable economy, obviously that will be costly, estimated at about tens of billions of dollars per year. How would this be paid for?
Well, it's a tricky one. I mean, I've seen a figure of $100 billion a year that is needed. We saw at COP26 $12 billion of public funds committed and another $7 billion of private. So that's very short of what is needed. But I think there's a huge opportunity here for the private sector with green bonds and blue bonds, because, you know, green bond is sustainable and protects the environment. A blue bond is about protecting ocean environments. We've already seen Senegal issue a blue bond 3 years ago, Egypt a renewable bond last year, and Côte d'Ivoire a sustainable bond for a sustainable shopping center. So there's a lot of opportunity here. And also, actually, the World Bank is actually talking about doing debt for climate adaptation swaps. So a country would get debt relief in exchange for taking climate action. So I think there's a lot of opportunity out there, but quite a lot of it needs to come from the private sector.
Right, and also with the carbon credits. Well, it's not just about money, it's about action, on the ground. What tools will be deployed to, actually achieve this, looking at monitoring, new tech and carbon credits?
Absolutely. Well, I think basically new technology can help hugely. If you just think of distributed power, solar power and individual stations, during the lockdown, that was one of the things that continued working. It was resilient. So these new technologies can really help so people have renewable power and are not actually cutting down forests. Then they can help for monitoring. You can see with satellite data and visualization immediately if there are areas which are being chopped down, so you don't turn up 3 months later and find a forest is gone. But I think also you mentioned the point about carbon credits. I mean, if they can come up with a proper model for carbon credits, they can actually turn the extractive model on its head. So instead of extracting and exporting resources, you preserve them and then you gain income and investment for their continued preservation rather than their destruction. That's where the real opportunity lies.
Right. Anyway, we'll be watching how the pledges actually turn into action. Well, Ted George, Chief Narrative Officer at Clio's Advisory, thank you so much for coming on the program and enjoy the weekend.
Thanks for having me.
All right, moving on now. The central bank has granted approval in principle for payment service bank licenses to two major telecom firms in Nigeria. That's MTN Nigeria and Airtel Africa. The minimum capital requirement, application and licensing fees for PSBs include minimum capital of 5 billion naira, a non-refundable application fee of 500,000 naira, and a non-refundable licensing fee of 2 million naira. A change of name fee of 1 million naira. PSBs are expected to leverage on mobile and digital channels to enhance financial inclusion, stimulate economic activities at the grassroots through the provision of financial services. Meanwhile, the central bank says it's reduced its expenditure on currency printing to 58.61 billion naira in 2020, down from 75.52 billion naira in 2019. The 2020 currency report posted on its website also indicates that the CBN spent the sum of 64.04 billion naira in 2018 for the same process, which was carried out by the Nigerian Security Printing and Minting Company. And while the financial market regulator explained that the reduction is in line with its objective to cut the cost of printing banknotes and cash management in the country. CBN also mentioned that the total stock of currency in its vault stood at 2.74 billion pieces at the end of December last year, compared with 2.64 billion pieces in 2019, indicating an increase of 105.73 million pieces or 4%. And global food prices have hit the highest level in over a decade after rising by more than 30% in the last year. The United Nations Food and Agriculture Organization, according to the Agriculture Organization, this comes as vegetable oil prices hit a record high after rising by almost 10% in October. The FAO says its index of vegetable oil prices was pushed up by rises in the cost of palm, soy, sunflower, and rapeseed oils. The agency's figures highlight the soaring cost of cereals and vegetable oils around the world. That's the disruptions to supplies, high commodity prices, factory closures, and political tensions are helping to push up prices. And to North Africa now, Egypt repaid $15.8 billion in foreign debt throughout the financial year of 2020 and 2021 ended. According to the Central Bank of Egypt, the money included $11.67 billion in debt installments and $4.16 billion as interest. Earlier, the North African country repaid $17.2 billion in foreign debt during the financial year ended in June 2020. And Zimbabwe's annual inflation will likely end the year between 55 and 65% against the government forecast of 53%. Due to volatility of the parallel market exchange rate. Finance Ministry recently revised annual inflation targets between 35 and 46%. In pressures from rocketing international food and oil prices are beginning to seep into the domestic market. According to the report, the central bank managed to keep money supply growth within the targeted level, with the Monetary Policy Committee revising downwards the 20% target growth in reserve money to 10% in an effort to contain the inflation growth. And that's it on Business Incorporated for the week. Thank you for watching. I'm Ladi Williams. Bye for now.